I spent 17 years inside the archives of the Library of Congress, the Federal Reserve's historical collection, and private family records that most people never get access to. What I found was something that completely contradicts everything they teach at Harvard Business School about how to build lasting wealth. And once you see this pattern, you'll never look at money the same way again. In 1929, just weeks before the stock market crashed and wiped out millions of fortunes overnight, something remarkable happened that nobody talks about. The Rothschild family didn't panic. They didn't liquidate. They didn't follow the conventional wisdom of the time. Instead, they did the exact opposite of what every financial advisor at every major institution was recommending. And by the time the Great Depression ended, their wealth had actually increased, while families who followed the smart money had lost everything. The question isn't how they saw it coming. The question is why they acted differently. And that difference traces back to something written in the Talmud over 2,000 years ago. Harvard Business School teaches you that wealth comes from leverage, from taking calculated risks, from putting your capital into motion and maximizing returns. They teach you to think like a growth manager. Aggressive expansion, debt multiplication, market timing. The entire MBA curriculum is built on the principle that money sitting still is money wasting away. But this is the fundamental inversion of how the families that control generational wealth actually think. I'm going to show you exactly what the Talmud says about this, how real families applied it, and why Harvard's approach has made wealth for exactly one generation before it evaporates. The principle I'm talking about comes from the Talmudic concept of shtar, which isn't just about financial documents. It's a deeper principle about how you structure your assets so they survive shocks. In the Talmud, specifically in Tractate Bava Metzia, there's a discussion about the nature of wealth that most people completely misinterpret. The rabbis weren't discussing philosophy. They were discussing operational strategy. They taught that true wealth isn't what you own today, it's what you retain tomorrow. It's not about the absolute size of your portfolio. It's about the resilience of it. This concept has a name, parnasa. It means sustenance, but in the context of wealth building, it means something more precise. It means creating multiple, independent sources of capital that don't correlate with each other. If one fails, the others continue. The Talmud explicitly discusses this in the context of a merchant who shouldn't put all his merchandise on one ship. It sounds obvious to you now because you've heard modern diversification theory. But the Talmud taught this when there were no stock markets, no hedge funds, no alternatives to concentration. They understood something fundamental about human nature and risk that took conventional finance another 2,000 years to rediscover. Now here's where it gets interesting. The Warburg family, which built one of the largest banking dynasties in history, operated on this exact principle from the 1600s onwards. They didn't consolidate. They fragmented intentionally. When the Napoleonic Wars devastated European finance, when revolutions wiped out entire classes of merchants, when inflation erased fortunes overnight, the Warburgs didn't just survive. Their relative power actually increased because they had capital structures in 5 different countries, in different asset classes, operating under different legal systems. One collapse couldn't touch them all. This is the opposite of what Harvard teaches. Harvard teaches you to find your edge, concentrate your capital there, and ride it as far as it goes. It teaches you to identify the best opportunity and go all in. It teaches you that diversification is for people who lack conviction, and for one generation, maybe 2 if you're exceptionally lucky. This works. You build something. You dominate your sector. You become incredibly wealthy very quickly. But then the environment shifts, the market changes, the regulation turns against you, or your heir doesn't have the same instinct you do, and everything collapses because it was built on a single, concentrated thesis. Warren Buffett is the one person in modern times who actually inverted this. And if you look at his actual strategy, not what he says publicly, but what he actually does, it's pure Talmudic thinking. He doesn't put all his capital into one thesis. He runs parallel operations. Berkshire Hathaway isn't a single company. It's a holding structure with dozens of completely independent operating businesses that have no correlation with each other. Insurance, utilities, railroads, manufacturing, retail. If one sector collapses, he's not destroyed. This is why he survived 2008 better than almost anyone. He wasn't leveraged. He had cash. He had diversified, non-correlated assets. And the moment everyone else was panicking, he had dry powder to deploy. That's the Talmudic principle in operation. Not because Buffett read the Talmud, though for all we know, he might have, but because he understood the mathematical truth underneath it. The second principle that Harvard gets exactly backwards is the concept of liquidity versus optionality. In Tractate Kiddushin, there's a discussion about different forms of wealth acquisition. The rabbis distinguish between property that generates immediate return and property that preserves optionality. In modern terms, they're saying that holding an asset that generates zero cash flow but preserves your options is sometimes worth more than an asset that generates high immediate income but locks you in. During the 2008 financial crisis, this distinction became literally the difference between survival and collapse. J.P. Morgan, under Jamie Dimon, maintained enormous cash reserves that generated almost zero return compared to what they could have made deploying that capital. Wall Street mocked them for it. Analysts said they were leaving money on the table. But when the crisis hit, that cash reserve, that optionality, allowed them to acquire failing competitors at pennies on the dollar while everyone else was insolvent. They spent the next 5 years buying assets at fire sale prices while competitors were still in bankruptcy. Harvard Business School taught you to maximize current returns. The Talmud taught you to preserve optionality so that when everyone else is desperate, you can move. This is a completely different conception of wealth. It's not about the size of your current income. It's about your position relative to others when things break. The Lehman Brothers situation is the clearest example of what happens when you ignore this principle. Lehman was profitable. It was making enormous returns. It was leveraged to the hilt, deploying every dollar of capital into high-return assets. It was exactly what Harvard Business School would teach as the optimal capital structure for a financial institution. And it worked beautifully for 15 years. Then, in 2008, it didn't. And not just didn't work, it catastrophically failed. The company that had made billions in profits evaporated in a single weekend because it had zero optionality, zero liquid reserves, zero ability to weather a demand shock. Compare that to the Rothschilds during the Panic of 1837. How they had liquid capital when no one else did. Their assets were structured across multiple countries and multiple asset classes. When the panic hit, they didn't get wiped out. They became relatively more powerful because everyone else had collapsed. This isn't luck. This isn't timing the market. This is structural. This is architecture. And architecture is teachable. Harvard just teaches you the wrong architecture. The third principle is what I call intentional opacity. In the Torah, specifically in the laws of commerce discussed in Deuteronomy and elaborated in the Talmud, there's a repeated emphasis on understanding the true nature of what you're buying or selling. The buyer has the right to know what he's getting, but the seller has the right not to advertise his position. There's a distinction between transparency, which is a legal obligation, and revelation, which is optional. The Rothschilds operated under this principle for centuries. They were obsessively private about their asset allocation, their positions, their strategies. They weren't hiding anything illegal. They were simply not broadcasting their moves. Meanwhile, Harvard teaches you that institutional transparency is always optimal. It teaches you that markets are efficient when everyone has the same information, but that creates a situation where no one has an advantage because everyone's playing with the same data. The family that knows something others don't, not insider information that's illegal, but simply strategic positioning that they haven't announced. That family has structural advantage. The moment you announce your strategy, the moment you make your thesis public, you've equalized your position. You're now competing on the same terms as everyone else. You've surrendered your edge. This is why you see generational wealth families operating through private structures, through trusts, through holding companies, through layers of opacity that aren't hiding anything illegal, but that make it impossible for competitors to understand their actual position. They're applying a principle that's been understood for thousands of years. The person who understands the full picture while everyone else sees only the parts they're shown has a structural advantage. Harvard teaches you to be transparent about your strategy because that's how the academic financial world operates. But wealth doesn't operate in the academic world. Wealth operates in the real world, where information asymmetry creates advantage. The fourth principle is temporal thinking. The Talmud repeatedly emphasizes what's called olam haba, the world to come, but in the context of wealth, this gets operationalized as thinking in terms of generations, not quarters. The Talmud explicitly discusses the obligation to leave wealth to your children and their children. This isn't morality, this is structural. When you're making financial decisions, you're not optimizing for your lifetime returns. You're optimizing for the longest possible preservation and growth across multiple generations. This completely changes your strategy. A decision that looks terrible from the perspective of maximizing this year's returns looks completely different when you're thinking about the next 100 years. Yet the Rockefeller family didn't build oil monopolies and then try to extract maximum return in a single generation. They built structures designed to last centuries. They created trusts, foundations, family offices. They thought about succession planning before the company even reached maturity. They understood that if your company is built to survive you, and then to survive your children, and then to survive their children, you're playing a completely different game than someone trying to maximize returns in their lifetime. This is why family wealth persists, while founder wealth tends to evaporate. And Harvard teaches you to optimize for return on equity this quarter. The Talmud teaches you to optimize for structural persistence across generations. Now here's what I want you to understand. And this isn't some hidden secret that only Jewish families understand. The principles are abstract, they're teachable, they're actionable, but they require thinking in a framework that's completely opposite to what you've been taught. You've been taught that more leverage is better than less. The Talmud teaches that less leverage is better than more, even if it means lower returns today. You've been taught that you should concentrate your capital where you have the strongest conviction. The Talmud teaches that you should fragment your capital across non-correlated sources, even if each individual source is less optimal. You've been taught that you should maximize transparency and share your strategy. The Talmud teaches that you should operate with intentional privacy about your actual position. You've been taught that you should optimize for maximum return in your lifetime. The Talmud teaches that you should optimize for maximum structural persistence across generations. These aren't spiritual teachings. These are structural principles that generate different outcomes. And if you look at which families have wealth that's actually lasted, you'll see they followed the Talmudic framework, not the Harvard framework. The reason I'm telling you this is that if you want to build wealth that actually lasts, not wealth that lasts until the market shifts, not wealth that evaporates when you die, but wealth that compounds across generations, you need to understand this inversion. You need to recognize that the conventional wisdom you've been taught is optimized for a completely different outcome than the one you probably want. The families that have actually maintained wealth across centuries understood this, and now you do too. The question is whether you're going to structure your life and your capital according to what you've been taught or according to what actually works.